Listen, if you watch silver hit 93.57 and then get smacked down like it touched an electric fence, you felt it in your stomach, because that was not normal selling. That was not people taking profits. That was a trap closing. And I know what the polite explanation is supposed to be. The market reacted to news. Macro changed. Dollar up. Risk on. Okay, sure. But if you look at the timing, the size, and the tools that were pulled out at the exact moment silver looked ready to crack 100, it stops looking like a coincidence. It starts looking like a playbook. So in this video, I'm going to lay out the proof in plain English. Not rumors, not vibes, not conspiracy poetry. A step-by-step chain of events that shows how this dump was engineered, how the headline was used as cover, and how the exchange itself helped flip the table. And just so we're clear, none of this is financial advice. I'm not telling you what to buy, sell, or hold. I'm showing you how the game gets played, so you can stop being surprised by it. Here's the core claim. This was a planned rejection. They needed silver to fail at the psychological level. They needed a clean reason for the news anchors, and they needed a mechanical trigger that forces weak hands to liquidate. What happened checks every box. The moment it turned. Let's start with what we all saw. Silver runs, it runs hard. It prints a fresh all-time high at 93.57, and then instantly you hit a wall. A massive wall of sell orders, not a gradual fade, not a gentle rollover, a wall. This is the first piece of proof, the character of the selling. Because when a market is naturally taking profits, you get distribution. You get back and forth. You get buyers stepping in, sellers stepping out. Price wiggles. This was different. This was a slam. This was the kind of selling that isn't trying to get the best price. It's trying to change behavior. It's trying to send a message. The message was simple. You are not allowed to get comfortable above 93. And if you want to understand the motive, you have to understand what 100 represents. 100 is not just a number. 100 is a headline. 100 is FOMO. 100 is every retail trader's brain lighting up. 100 is margin calls on the wrong side. 100 is boardrooms asking why a boring metal is acting like a meme stock. So if you're short, or if you're managing the optics of a system, you don't want 100. You want rejection. You want a clean top. You want people embarrassed for believing. You want the crowd trained. The convenient headline. Now here comes the second piece of proof. Just as silver looks ready to break the big psychological level, the US government releases a statement deferring tariffs on critical minerals, including silver. Notice the framing. Not canceling industrial demand, not discovering a new silver mine the size of a continent. Not announcing a breakthrough that makes silver obsolete, just deferring a policy path, a delay, a deferral, a schedule change. So ask yourself a simple question. If the metal is truly disappearing in the physical world, why would a policy delay create an instant 3% dump? Did the solar industry vanish in the last 2 hours? Did AI data centers turn off their servers and apologize for buying silver? Did EV manufacturers suddenly stop needing conductive material? Of course not. This headline did not change the physical reality, it changed the story. It gave the media a reason to explain the move after the move happened, and that is the point. Markets love cover stories. Big players love cover stories even more. Because if you can say, yes, it was the headline, you don't have to say it was the order wall. This is what professionals call narrative control. You drop the price first, then you hand the public a sentence to repeat. The perfect excuse, jobless claims' third piece of proof. The catalyst. U.S. jobless claims come in unexpectedly low, 198K versus 215K, estimated. Most people hear that and think, good news, people working, economy strong. But in macro land, good news often means one thing, rates stay higher. The dollar gets stronger, and precious metals get hit. So what happens? DXY spikes, algos wake up, macro funds press their buttons, and suddenly the sell wall has the most believable excuse in the world. See? Dollar up, metals down, totally normal. Except again, watch the order of operations. Silver was already showing the rejection. The wall was already there. The move already had the fingerprints of a stop hunt. Jobless claims didn't create the dump. Jobless claims gave the dump a mask. The kill switch, nobody talks about. Now we get to the part that turns this from suspicious to mechanical, the margin hike. Earlier this month, the exchange raised margins for silver by about 47%, up to 30,500. Let me translate what that means in human language. If you want to hold a futures contract, you have to post collateral. That's margin. When margin goes up, the cost of staying in the trade goes up. So who does that hurt? Not the biggest banks, not the biggest funds. It hurts the smaller longs, the leveraged participants, the people who are right on direction but weak on staying power. And when you raise margin aggressively, you create a forced seller, not because they changed their mind, because they can't afford to hold. That's why I call it a kill switch. It doesn't matter what you believe. It matters what you can pay. So when silver dumps $3 in a fast move, after margin has been hiked, you get a chain reaction, stops trigger, equity drops, more margin calls, more forced liquidation. And who benefits from forced liquidation? The side with cash. The side that can wait. The side that can buy the puke. If you want a simple mental image, picture a crowded elevator, then someone doubles the weight limit requirement. Half the people are forced out immediately. The people with the strongest legs keep their spot. And then the doors close, that's the margin hike. And this is why the dump looks planned. Because if you were going to engineer a rejection, you would want the market primed. You would want leverage punished. You would want the weak longs already one bad candle away from a call. They did that. Then they pushed the candle. Why the tariff news is a distraction. Now let's talk about the tariff story, because this is where the psychology gets weaponized. The argument being sold is simple. Tariffs delayed, so silver drops. But that is a nothing burger if you zoom out, because the core issue is not a policy headline. The core issue is physical imbalance. Over the last 4 years, the claim is that physical silver supply is in a 700 million ounce deficit, meaning demand has exceeded supply by an enormous amount. Whether that exact figure ends up being 680 or 720 does not matter for the point. The point is, the world has been consuming more silver than it produces, and industrial demand is not a mood. AI servers do not care about a press release. Solar panels do not respond to a politician's schedule. Electronics do not wait for a tariff committee to finish lunch. So if nothing physical changed, why did price react like the metal suddenly became abundant? Because price did not react. Price was moved. The headline was the story. The story was the permission slip. And here's the funniest part. If you believe the rally was driven by tariff fear, then deferring tariffs should reduce urgency. Yes. But it should not create a vertical wall of selling at the exact moment the market is about to print a historic psychological number. That's not how less fear looks. Less fear looks like slower buying. Less fear looks like a sideways pause. Less fear looks like normal behavior. A wall looks like defense. What the proof actually is now. I want to be careful with the word proof. I'm not sitting in the exchange server room. I'm not reading private chat logs. So when I say proof, I mean something more practical. A pattern of evidence that is far too consistent to ignore. A chain where every link supports the same conclusion. So here are the receipts, in order. Receipt number 1. The level. 93.57 was an all-time high. All-time highs are where psychology is the most fragile. Breakout traders pile in, shorts get nervous, the crowd expects fireworks. If you want to stop a run, that is the moment. Not later, not after it consolidates. Right there. Receipt number 2, the wall. A wall of sell orders at the top is not the market. It is someone with size choosing to cap the move. Receipt number 3, the speed. The drop toward 90 happened fast. Fast drops are not about price discovery. They are about stop discovery. They are about finding where the weakest hands are holding on. Receipt number 4, the narrative timing. The tariff deferral statement arrives right when the market needs a story, not a week before, not a week after, right then. Receipt number 5, the macro excuse. Jobless claims surprise prints, DXY pops, now the dump is macro, now it is normal. Receipt number 6, the preloaded kill switch. Margin was raised earlier in the month, so the market was already primed for forced liquidation. Receipt number 7, the behavior after the dump. Watch what usually happens after a forced move. Volatility spikes, retail panics, social media fills with fear, then quietly the market stabilizes. Because the goal was not to destroy silver. The goal was to reset positioning. They want the longs that cannot endure. They want the shorts that can. How the machine works. Let me explain the machine in the simplest way. The paper market is a leverage machine. Futures allow you to control a lot of silver with a relatively small amount of collateral. That leverage cuts both ways. When price rises, leveraged longs feel like geniuses. When price drops, leveraged longs become forced sellers. A forced seller is gold to the other side because a forced seller sells on schedule, not on value, not on conviction, on margin. So if you're a large entity, and you want to buy back shorts or accumulate at a better price, you can do it in 3 steps. Step 1, raise the cost of holding. That's the margin hike. Step 2, create a fast dump to trigger stops. That's the wall and the slam. Step 3, provide a headline so the world doesn't ask why. That's the convenient news. And if you can stack a macro data point on top, even better. Now it's rates. Now it's dollar. That's how the machine stays socially acceptable. What this means for you now, what do you do with this? Because I know some of you are watching like, okay, cool, it's rigged. Now what? First, you stop trading this like it's a fair game. If you are leveraged, you are playing inside their arena, and their arena has switches. Second, you start watching the right indicators, not just the price. The price is the final output. Watch the inputs. Here are 5 inputs I would watch like a hawk. Exchange margin notices. If margins move, the rules of the game move. Open interest behavior on big levels. If price rises but open interest collapses, someone is closing, not building. Spot versus physical premiums. If paper drops but physical stays tight, the disconnect is telling you the truth. Inventory changes. If registered inventories fall while price gets slammed, that is stress. The pattern around round numbers. Round numbers are where traps get set. 50, 75, 100. Humans love them, and that makes them exploitable. Third, you protect your psychology, because the real target of these dumps is not your portfolio, it's your belief. They want you to say, I knew it. Silver always does this. It's hopeless. Because the moment you emotionally quit is the moment you hand them your future upside. The reframe. Paper is the battlefield. Physical is the war. Let me give you the cleanest reframe I know. Paper silver is where the war is fought. Physical silver is what the war is about. The paper market can move violently on headlines, margins, and positioning. Physical does not teleport. Physical does not care about a payroll print. Physical is mined, refined, shipped, and consumed. So if the underlying story is a structural deficit, then the paper shocks are not truth. They are tactics. Tactics to shake hands. Tactics to reset positions. Tactics to buy time. And that is why a 3% dump on a policy delay is such a red flag, because the physical story did not change. Only the paper behavior changed. The most important question. Here's the question I want you to sit with. If silver was genuinely free and purely reacting to new information, what is the probability that all of these things align on the same day? An all-time high touch, a perfectly placed sell wall, a tariff deferral headline right as 100 is in view, a macro print that boosts DXY, a margin regime that makes longs fragile. What are the odds that the market just happened to step on every banana peel in the house at once? Low, very low, which means the more honest answer is somebody stacked the peels. What I think happened in one sentence. Here it is. The dump was planned to prevent a clean break toward 100, and it used a headline plus a macro data point as cover, while the margin regime forced weaker longs to liquidate into a pre-positioned wall. That's the play. Now, I'm not saying the price cannot go lower in the short term. It can. The paper market can do anything. What I am saying is this. If you understand the playbook, you stop being shocked. When you see a vertical run into a round number, you expect defense. When you see a sudden margin hike, you expect fragility. When you see a convenient headline, you expect cover. And when you stop being shocked, you stop being easy. If you want, I can do a follow-up where we build the exact timeline, candle by candle, what to watch in DXY, and the key levels where the next trap is likely to be set. If that would help you, comment the word proof. And if you made it this far, hit like so this gets shown to the people who keep asking, why does silver always do this? Because it doesn't always do this. It does this when somebody needs it to. The mini timeline that gives it away. Let me paint the picture like a detective board, because when you lay these events on a simple timeline, the coincidence excuse gets weaker and weaker. Picture the trading day like a stage. You have the price actors on the front. But behind the curtain, you have 3 stagehands holding the ropes: leverage, liquidity, and narrative. Here is how a planned dump usually looks. Step A, you let the price run, not forever, just enough to lure breakout money, enough to get influencers screaming 100 incoming, enough to get new longs opening right into the top. Step B, you wait for a scheduled headline window. Economic data releases are not random. Policy statements are not random. Markets have known time slots when the crowd is already looking at the screen. That's where you hide your move. Step C, you hit it with size, not a drizzle, a slap. Because you are not trying to sell your position, you're trying to flip sentiment. So when silver printed 93.57 and then immediately got pushed toward 90, ask what kind of participant sells like that. A participant who wants out slowly would never choose that. They would feed the market. They would use strength. They would hide. A participant who wants a headline chooses the loudest possible candle. Why the dollar story is too clean. Now let's talk about the DXY excuse for a second. Yes, a stronger dollar can pressure metals. Nobody is denying correlations exist, but correlation is not causation. And on days like this, correlation is used as camouflage. Here's the trick. If you already planned a dump, you pray for a macro excuse. If you get one, you can sell the move as responsible. You can say it was data-driven, you can say the metal reacted, but what would it look like if the dump was actually caused by the dollar? It would look like the dollar moved first, metals followed, and you would see a broad, complex reaction at once. What people saw instead was silver acting like it hit a ceiling. Right at the moment, it threatened a psychological breakout, and then the macro explanation arrived like a neatly printed label. That is why I call it too convenient. The margin math in real numbers. Let me make the margin piece painfully concrete. A standard silver futures contract represents a lot of metal, roughly 5,000 ounces, so a $3 move is not $3. It's roughly $15,000 per contract. Now remember what margin is. It's the money you have to keep on deposit to stay in the position. So if the exchange raises margin up near 32,500 and then the price drops fast, what happens to smaller traders? They get a call. Not a suggestion, a call. Add funds or reduce the position. And if they can't add funds, they are forced to sell. They sell into the drop. They sell at the worst time. They become the fuel. That's not theory. That's the plumbing. And when thousands of smaller participants are forced to reduce risk at the same time, price doesn't discover. It cascades. The options magnet around 100. Now let's talk about the big round number problem, because 100 isn't just a psychological level. It's also an options level. Big strikes attract hedging flows. They attract gamma dynamics. They attract dealers who have to rebalance. So if a lot of open interest sits around 100, the market can behave like it's magnetized. Sometimes it accelerates into it. Sometimes it gets pinned below it. Sometimes, if a break would create chaos for the wrong side, it gets defended. So when you see a violent rejection right before 100, you should at least consider the possibility that the defense had a mechanical reason, not just emotion. Why this is psychological warfare. Let me tell you the part that most people miss. The target of these dumps is not price, it's memory. They want you to remember the pain. They want you to associate silver breakouts with humiliation. They want you to flinch when you see strength. Because if they can train you to sell your own conviction, they don't have to fight you. You fight yourself. And the easiest way to create that training is to do it at all-time highs. Because highs are where hope is loud. So a dump at highs is a public execution of hope. How you can verify this without trusting me. You don't have to take my word for anything. Here's how you can check the story yourself. 1. Look up the exact timestamp of the jobless claims release, then overlay it with the candle that started the heavy selling. Was the selling already underway? Did it accelerate right at the release? Did the move look like a planned trap that used the release as a trigger? 2. Check the exchange margin notice date. Was margin raised before the dump? If yes, that means the market was already in a tighter collateral regime. 3. Look at volume on the rejection candle. A true profit-taking top usually distributes over time. A manufactured rejection often concentrates. 4. Look at open interest changes afterward. A flush often reduces open interest as positions are forced out. That is the reset. 5. Compare paper price to physical availability. If the paper price dumps but physical premiums stay stubborn, that is the tell. This is not mystical. It's forensic. The real reason. The tariff story doesn't matter. Even if you believe tariffs were a major driver, the real driver is still the same. Scarcity pressure meeting industrial reality. If industrial demand is rising and the supply chain is tight, a policy deferral does not magically refill warehouses. It does not add new mined ounces. It does not reverse years of deficits. So if the market is acting like the problem vanished, you have to ask whether price is reflecting reality or reflecting positioning. The 3 levers they pulled today. If you remember nothing else from this video, remember this framework. They pulled 3 levers. Lever 1, narrative. They handed the public a reason. Tariffs deferred. Dollar up. Lever 2, liquidity. They hit the market when it was easiest to gap it, so stops would chain. Lever 3, leverage. They raised the cost of holding, then used volatility to force liquidations. When those 3 levers align, the move is not a surprise. It's a procedure. What I expect next. Now, does this mean silver cannot rip higher anyway? No. Markets can snap back violently after a flush. In fact, flushes are often the precondition for the next leg, because once the weak longs are gone, the market is less fragile, and once the short side has taken profit or reduced risk, the pressure changes. So if you see stabilization after the dump, or you see physical tightness refusing to ease, do not be shocked if price tries again, but watch the same danger zone. Watch the round numbers. Watch the narrative windows. Watch the margin regime. Because if they defended 100 once, they can defend it again. The point of this video is not to make you angry. It's to make you aware. If you think every move is pure supply and demand, You will keep getting blindsided. If you think every headline is the cause, you will keep getting emotionally steered. But if you understand the machinery, you start seeing patterns early. You start anticipating the tricks. You stop panic selling into their liquidity vacuum, and that is the real edge. Not prediction, preparation. If you want the candle-by-candle breakdown next, comment proof. And share this with someone who still believes that a 3% dump on a policy delay is just the market, because the market didn't just move today, the market was moved. If you got lost in the details, here is the whole case in one fast pass. Silver hit an all-time high at 93.57. A heavy sell wall appeared right where a breakout toward 100 would start. The dump was sharp and fast, the kind of move that hunts, stops, and forces liquidation. A convenient government statement about deferring critical mineral tariffs showed up right when the market needed a story. Jobless claims printed unexpectedly low, 198K versus 215K EST, pushing DXY higher and handing the dump a macro excuse. The exchange had already raised margins by about 47% to roughly 32,500, making smaller longs fragile. Fragile longs became forced sellers, and forced sellers became the liquidity the other side needed. That is the checklist. 5 questions to ask next time. When you see a violent dump again, run these 5 questions immediately. Question 1, what level did it happen at, and what headline number was it trying to prevent? Question 2, what scheduled data or policy window is happening today that can be used as a cover story? Question 3, has margin been raised recently, or has volatility made collateral requirements tighter? Question 4, did the move look like somebody trying to exit or somebody trying to punish? Question 5, did physical conditions change or only paper behavior? Because if only paper behavior changed, then the move is usually positioning, not reality. Final note. The reason I keep repeating this is simple. The crowd keeps thinking the market is a scoreboard, but in moments like this, the market is a weapon, and once you see it as a weapon, you stop taking the bait. If you want a simple watch list, here it is. Watch the next margin notice, watch DXY reactions to data, watch how silver behaves near the next round number strike, and watch whether physical premiums refuse to relax even when paper gets hit. When those diverge, that's the signal that the paper move is a tactic, not a cure. And remember, the goal of a planned dump is to make you feel like you're late, wrong, and alone. You're not. You're just watching a process. Stay calm, stay curious, and stop handing them your conviction for a headline.